we're ready to begin.
Yep.
All right. Just to keep track, that's 107. We're going to kick the meeting off with moving up item number 5 to the beginning of the meeting.
Right.
So, my name is Gary Ameling. I am the new Chief Financial Officer for the city. I've been here since the 15th of February, so this is my 3rd week. And I have previously chaired deferred comp committees in other cities that I've been at. And I've worked with ICMA and Mass Mutual, formerly Hartford, and previous cities that I've been at. I've never worked with Nationwide before, so got some familiarity with the topic at hand.
Nice. I think we should probably just make a motion to take a vote to ratify Gary's appointment as chair of the committee.
Second.
All in favor say aye.
Aye.
Aye. All opposed say nay. You don't vote. So the motion passed unanimously.
So this needs to be just another stack of documents.
Pretty much.
Okay, then moving back to agenda item number 1, approval of the 3rd quarter 2016 meeting minutes. I was not at the meeting, so I will abstain. Anybody have any changes to it? I did notice on the top of page 2, the first bullet, it should say money market, not monkey.
That's a special fund we have with the Fidelity.
Ah, okay.
Good catch.
So, folks have read through the minutes and they seem to match up with what your recollections were, then I would entertain a motion to approve.
Second.
Who gets first? I need a
Oh,
motion.
first, sorry.
Everybody ready? All in favor, say aye.
Aye.
Opposed? Sounds like that passed unanimously with a couple abstentions. Okay, agenda item 2, consent funds. Consent item funds ranking below 50th percentile and Morningstar, some categories with 3 and 5-year annualized periods. We have one from Mass Mutual, one from ICMA, and none from Nationwide.
Correct.
These are new ones that you put on watch list? Is that
That's
what it is?
exactly right.
Okay.
And they'll be reflected when we get into the review material.
You have other ones that are already on watch list, I would assume.
Yeah.
Do you typically present these?
Yes, when we get into the, through your, like it says, 3 record keepers, so 3 different review books, and when you go through the rankings, you'll see how it's noted in there.
Okay. So do we usually vote on this at this time?
No,
Or
but
your presentation?
and that's a good point, Gary.
I think you would do the presentation first, and then you would
Yeah,
discuss
well-
putting on watch list.
Well, so it's been the general procedure that some committee members, in the past have had a preference of just identifying funds that new funds that have newly fallen below the 50th percentile to save the committee the task of making a motion to put it on watch. So we just list the consent items up front, and we'll tag them again when we get into the review.
Do you have other kinds of scorecard type criteria to look at besides Morningstar ranking?
That's a very timely question.
I'm used to having like 10 categories of check
Yeah.
boxes.
Yeah, so, and that was another agenda item that I was going to touch on, but to answer your question now, for the longest time, I have been using, Morningstar category 3 to 5 years, and I explained to the committee actually last quarter that, we're all a product of people who have influenced our lives and our experiences, and early in my career, I had a mentor of sorts that said, if you use the top 50 percentile 3 and 5, the committee, can be very confident in saying, our funds are better than most. And if they're not, we'll put them on watch and they be subject to replacement. And so we've been, using this criteria for all these years, and from a process standpoint, I think the important thing is that if you have a policy and you follow it and you document when you make decisions, you're going to be fine from a procedural standpoint. But your question's timely in that, you know, I'm a 20-year veteran, and, you know, every once in a while you maybe do some soul searching as, you know, should we be rethinking this? And I've been working on a project internally within Morgan Stanley and speaking with senior management within retirement services and amongst my peers and people in the firm of corporate retirement directors such as myself that I have a lot of respect for, to solicit opinions, you know. What is the correct investment policy monitoring criteria? Because you could get, you know, 10 consultants in the room and they could all have different answers. And, you know, there's probably pro and con for different metrics to use. So last quarter I came in here and presented to the committee, you know, let's rethink this. Sometimes you have to kind of challenge the status quo as you evolve and maybe take a more, you know, academic approach. And I presented 12 data points that talked about not just 3 and 5 rankings, but start layering in 10 years for a longer term, you know, view in a retirement plan format. And then other, you know, metrics like, you know, Sharpe ratios, risk adjusted curve. All in all, there were 12 different metrics. Yes, and you know, we have a reporting tool that you'll see. Right now, it's set for 100 scores on each fund to be term compliance for 3 and 5 year. But it expands it out to 12 metrics, and the idea is that if you get a 50% pass rate on at least 6 of the 12, then the fund is in compliance. And if it would be below that for, you know, 4 consecutive quarters, then you can put it on watch. In that case, you know, you're looking at a more comprehensive set of data, give funds maybe a chance to play out over a market cycle, let's say. And it was the first pass at a committee last quarter here. Julie had some questions about it. She didn't understand why. So your question's timely, and as far as the project, I'm still working on it internally because, you know, it's one thing to have funds and monitor them with those data points. It's another thing to then apply those 12 data points to identify funds for replacement that will slate into the lineup in compliance. So it is a project that's ongoing. I would move to expand it, so it's to be continued.
Would it also help if we could do a real fast, high overview of where we started from, what we might have accomplished, and what are some of those things in our bylaws, like the consent items for Gary, so he would have a better understanding as we're going forward in this meeting as well. I don't know how much he has been briefed on.
How much?
Yeah.
Yeah.
And I know he's got just a stack of documents that everybody's been giving him to read through, and everybody expects him to know it once they gave him that stack.
Yeah, you know, I understand you just got here. You've been busy to say the least, but, you know, frankly, I would love a chance to meet with you, you know, one-on-one. Vince would have you kind of take you through the chronology of where we started, where we've come, and, you know, get you current, so.
Okay. Yeah, I don't want to hold the meeting up at all with any kind of special
Yeah.
educational session for me.
It would be my pleasure. And then another note that I had made, and this goes back to the operating guidelines document, that, you know, when this committee was formed, I delivered a fiduciary training curriculum, and the operating guidelines indicate any new committee member should get that curriculum as well.
Okay.
Now, given your history of being on the committees previous, you're probably the last person that really needs it, but to stay, you know, compliant with the document, you know, I can give it to you, and, you know, it's just it would be basic for you.
Do most of the members here have tenure of multiple years on the committee?
No, there is inevitable turnover. Original members are Vanetta, Edward, John,
So it's
Jude.
not been around very long in the committee?
No, committee started in about 2014.
Oh. How did we meet our fiduciary obligations prior to that? Basically roll the dice.
Yeah, that's why
We look forward on the committee, we don't look backwards.
All right, okay.
That's why I said he might want to.
Has anybody gone through like any kind of NAGDA training or some kind of people to train? Aside what
No. Previously, one of the agenda items is the annual benchmark reports. It's an annual ritual we do here, and the consultant fees through Morgan Stanley have been paid out of the plan sponsors cover to kind of, form the committee, get us going, and we've accomplished a lot in the last, 2.5 years or so. But I had raised the issue of qualified plan expenses to previous Chairman Vincent, and he said that it was money well spent during that time, but going forward, should there be a recession and tax collections are down, property value, and all of a sudden there's budget cuts, he wouldn't want to have to compromise the budget cut through a consultant for comp. So effective, actually, January 1st of this year, there is revenue. The record keepers have negotiated for them to lower their required revenue and to pay Morgan Stanley from their cut. And so the benchmark reports that we'll do today are up as of December 31st, so that when we meet next year, it'll show the revenue coming out of the plan. Now, 2 of the record keepers have agreed 100%. Mass Mutual has met the city in the middle, basically, lowering the revenue partly, and so the city, instead of having an exposure of 105,000 a year, which is a 4 point some odd basis points on the 240 million, the city will have to pay about 35,000 thereabouts. So they've lowered their exposure from 105 to about 35.
Is the 240 million the total value of the entirety of all of this?
Yes, between the 3 record keepers. So again, there's a lot to absorb and do a simulation, and anything I can do offline, we can meet, try to get you up to speed.
Okay. So then the consent items, do we typically vote on them?
No, that's a point that they're consent, so you don't have to vote on them.
Okay. But it says to be approved in one action. Maybe implies votes needed.
Okay.
Because that's what the little note says here.
Yeah.
Below that.
If you want to make a motion to approve?
I guess I'd like to hear about the funds before I make the motion.
Okay, well then,
There must be some reason why they fell below, and I'd like to know that.
okay. Well then, why don't we get into the first review book and nationwide. And we will come across that American Century Fund. So within the Mass Mutual book, we'll start on page 6. I will summarize the capital markets overview for the fourth quarter 2016. The election of Donald Trump as the next U.S. president set markets surging to new highs during the fourth quarter of 2016. Trump's pro-growth agenda, focusing on infrastructure spending, tax reform, deregulation, fueled the markets in the so-called Trump rally. Along with the election, all eyes were on the Federal Open Market Committee as U.S. reporting improved inflation expectations and employment numbers giving the Fed a green light to hike rates in December. The expectations fully priced in, markets reacted calmly when the Fed did raise interest rates by 25 basis points and signaled potentially 3 more hikes in 2017. U.S. equities posted strong returns. Financials within the S&P returned 21.1%. REITs and long-term treasuries lagged the market on the back of increasing inflation expectations and rising real interest rates for 1-year period ending December 31st. MLPs, those are master limited partnerships, U.S. high-yield corporate bonds, U.S. equities, and emerging markets led the path with double-digit returns. The Dow Jones was up 8.7% for the quarter. NASDAQ was up 1.7, S&P 500 was up 3.8%. 8 out of the 11 sectors in the S&P 500 were positive for the quarter. Financials up 21.1%, energy and industrials are up 7.3 and 7.2. The laggards are real estate, which is down 4.4%, healthcare was down 4%. Bond market registered negative returns. Now, I caught some sort of a mistake in this printing. It says Bloomberg U.S. Aggregate, that should be Barclays. The general measure of the bond market decreased 3% for the quarter. Morgan Stanley economists expect U.S. real GDP to be 1.16% last year and 2% this year. They forecast global GDP growth to be 3% last year, increasing to 3.4% this year. Commodities were positive, up 2.7% for the quarter. Page 7. The gross domestic product increased at an annual rate of 1.7% during the third quarter of 2016, in comparison to 1.3% in the second quarter of 2016. Unemployment rate in November was 4.6%, down from 4.9% in August. Employment increased mostly in professional business services and healthcare. The number of unemployed declined to 7.4 million people from 7.9 million in the previous quarter. Corporate profits increased 5.8% between the second quarter and the third quarters of 16, and rose 2% in the third quarter of 15 and the third quarter of 16. Inflation, based on the Consumer Price Index, was 1.1% in August and increased to 1.7% in November, a level last reported in 2014. So inflation is picking up. Morgan Stanley forecast inflation for 2017 at 2.4%. Private sector housing starts in November 2016 were at an annual rate of 1,090,000 homes, 6.9% below November 15 housing starts.
Is your inflation projection including or not including
energy?
It is included.
I would have to verify that. Usually it's taken out from core inflation because it's so volatile.
Yeah.
But I can clarify that.
We're starting to see a little spike, I think.
Pardon me?
We're starting to see, I think, a little spike.
In fuel? Yeah.
Head back towards $3 pretty quick here.
Yeah. All about the supply, you know. There's, the purchasing index, purchasing managers index and manufacturing sector index increased as a PMI registered 54.7, a 3.2% uptick from September's reading of 51.5. Anything over 50 indicates the sector is expanding. Page 8. We talked about the market returns. You see in the table below. Gosh, what a great time to be invested in the market, building wealth, and the deferred comp plan. S&P, Dow Jones, Russell 2000 small caps, mid caps, and the Russell 1000. You see very nice returns for the quarter. Amazing 12-month return, but then even if you go out 7 years annualized to be in the market and getting annualized returns is a beautiful thing. Now, from a style perspective, the last several years, growth has outperformed value in terms of style. That is starting to change a little bit within the large caps. The Russell 2000 Growth Index is up 1% for the quarter, and where the value index was up 6.7%. In the mid caps, mid cap growth was up 0.5 to 1%. Mid cap value was up 5.5% for the quarter, and in small caps, small cap growth was up 3.6%, and the small cap value index was up 14.1%. So you see value starting to outperform growth.
That's right.
Yeah, page 9, global equity markets. have lagged down in the table. You see the EAF index, which is we talked about the developed international index equivalent to our S&P 500, down 70 basis points, up a small 1.5% over the last 12 months. Europe down 40 basis points. Japan down 10 basis points. The emerging markets, although down 4.1% for the quarter, is that amazing recovery over the last 12 months, up 11.6%. Page 10, the bond market. The table down below, you see the Barclays Capital Aggregate Index down 3%. Not surprising given the rise in interest rates. High yield with a bigger coupon and good credit environment. Fared the best, up 1.8, up 17% the last 12 months. And you see government bond, no surprise, down 3.8, pretty defenseless in a rising interest rate environment. So that is our capital markets overview. And now for the investment performance review on page 19.
Is that overview you just gave us, it's not specific to Mass Mutual, right? It's your overview for
Yeah, the whole market.
general market.
Yes. Yes. And now if we go to page 19. There is our watch list, carried over from the previous quarter. Oakmark Equity Income, Mass Mutual Select, Hoskins and Wiley Mid Cap Value, Invesco Small Cap. And when we get into review, we will look at a fund search for mid value and small value category. If you could please go to page 21. There's our style maps, and Gary, for your benefit, when we started this project, there was a tremendous amount of fund overlap. We significantly reduced the number of funds and made a more concise, tight investment lineup. There's the target date fund offering. The committee had made a decision to any small slice of bond exposure, whether it's high yield or government bond fund, has consolidated into Hartford total returns and core plus strategy. Of course, you've got the TIP fund and the PIPCO real return. Page 22. Again, nice and tight. In the large cap space, you've got one large value fund, you've got one actively managed large growth fund, and down the middle in the blend, you've got the Oppenheimer Main Street. Hartford Capital Appreciation was consolidated into into Oppenheimer Main Street, and then participants have the option to index Royal Fuse S&P 500 fund, and then the funds in blue are the mid value and small value. Those are the funds for consideration, that those funds are unwatched in. In the small growth, the Hartford Small Company Fund has been consolidated, replaced with Invesco. And then you'll notice in the foreign equity, we've got one international fund and one global fund. And then there's the three sector funds. If you go to page 23, top performing funds and the lower performing funds and small caps have just killed it. Tremendous returns. Now Hoskins and Wiley, in spite of it being up 20% for the year, it is on watch based on its rankings. Page 25. There's the asset allocation, and you'll notice on the left there's very, very small representation of the target date funds. Good, very perceptive. So the general account, we've talked about it. It's always a point of discussion in every quarterly meeting because Hartford, 4%, yeah. So you can see the
500 was up, what was it, 12% or something, to 4% of this year.
That is true, that is true. But anyway, you know, the target date funds just aren't really attracting much money within Mass Mutual. And, you know, a lot of plan sponsors are doing something. There is a trend out there. I'm not saying it's right, wrong, or different, but there is an industry trend out there that plan sponsors are re-enrolling all participants into target date funds, you know, with an opt-out provision. And they rationalize that on the premise that participant outcomes are going to be much better with a diversified account that will de-risk itself over time. You know, you worry about communication, how that would be received by a participant. But you know, I think it's my job to bring new industry trends and best practices happening out there. Not that it's going to be right for every committee or every organization, but it is happening out there.
We had some discussions the first year about doing that.
Yeah.
And I believe at the time, Julie and Rusty were really firm against it.
Right.
Because we know that some people aren't participating all the time, and then they're not doing anything. This would kind of force them a little bit into the plan.
Yeah, I understand, you know, the reluctance to do something. I mean, you know, that is the extreme spectrum of a trend, without a doubt. But, you know, again, everyone has the option to opt out of that program and back into their work they're comfortable. But just an anecdote. But, you know, if there's any interest in anything as a follow-up, please let me know. I can develop it further.
Is the educational side of the deferred account come through HR?
Yes.
And do the reps from the companies have days when they're available, people to meet with?
Yes, we have it published on our nets, on our internet site where employees can go ahead and schedule their appointments with the representatives.
Something we did, we were in Mass Mutual in my last city, one thing that they did, that we worked on as a committee was an easy enrollment form.
Mhm.
I don't know if we have that here or not, but basically there's, you know, the full enrollment form, which has all of the fun lineup on it, you can pick and allocate your percentages, et cetera. But if you just want something easy, you're more sophisticated, you're trying to just get started, easy enrollment just automatically puts you into a target date fund based on your age.
It's a great idea.
Just check a box and sign your name and you're in. Just
Yes.
Get started.
Yep.
And then you can start to do your own research and that's what we want to do in the future.
Yeah. Transamerica does that, like Station Casinos at Fine and Wine, and Transamerica does that at Station, and you know, the committee loves it. It's very efficient. And quite honestly, a lot of participants don't, you know, want to go through the mental exercise of trying to figure out asset allocation
And they're
and
just
the
staying on the
funds.
sidelines because they don't feel like they know enough.
Right. And the irony is that they're probably better off in a target date fund anyway. So.
So what percentage of our employees are participants?
About 65%.
It must be small dollar participants if you only have 250 million.
Well, average account balance is over 90,000. So it's pretty good from that standpoint. It's one of the healthier metrics.
Includes the people that have already separated.
Yes. Page 26. There are the fund values, and again, there's that very glaring 75 million, which is almost 50% of the plan assets in the general account. There's the assets in the target date funds. You see the zero in the Hartford Capital Appreciation. I mentioned it was consolidated with Oppenheimer Main Street, or replaced, I should say. And then down below, there's a Hartford Small Company, zero balance. It was replaced with Invesco Small Cap Growth. And page 27, 152 million.
So, big chunk of money is in Mass Mutual then compared to ours.
Yes, they're the longest incumbent, tenured incumbent record keeper dating back to probably 1984, I want to say, somewhere around there.
So I think ours we get added after.
Correct.
And is it true that Nationwide
30, please. Or page 29, just for a second, just so Gary could see that, our reporting tool is software where we essentially hardwire all the IPS monitoring criteria in the reporting software. And so we want to be, better than equal to the median in the peer group for 3 and 5 year. Now at page 30, and there are the rankings. Hartford total return, top quartile, PIMCO real return in compliance, Oakmark equity, has been on watch. The 5-year rankings are very good. Now 2 quarters ago in the 5-year it was ranked 48, still in compliance. Last quarter it was 38, and this quarter it's improved to 29. And on the 3-year, 2 quarters ago, it was ranked 53rd. Last quarter it was ranked 69, and this quarter is improved to 43rd. So it is officially and technically in compliance now, and I believe I would encourage somebody to consider a motion to take it off watch on those merits.
So you can't, there's no like symbol or anything on your readout showing that it is on launch?
Well,
We did it on the page earlier,
On page earlier.
and then in the minutes we also talked about it.
How long has it been on the watch for?
Yeah.
This one,
Just last quarter?
well, I missed,
yeah, if you go back to,
it's been a couple of quarters, I believe.
yeah. You go back to page 19, it was placed on watch at the end of the second quarter last year. And, it's been under pressure on the 3-year, but that's improved, so it really should be taken off watch.
Okay.
I make a motion to take Oakmark equity and income investors off the watch.
For a second.
I'll second.
All right, all in favor, say aye.
Aye.
Opposed? That's unanimous.
Okay, moving on down the line, there's our T. Rowe Price retirement date funds. We did do a target date analysis probably a year and a half ago, and determined that based on the demographics of high account balances, participants tend to keep their money in the plan after retirement, and also the PERS benefit. It was an overwhelming indication that through retirement, higher equity exposure throughout the glide path construction was more appropriate, so we replaced the old State Street index funds that were too conservative. They were ranked in the 99th percentile. Did a fund search. T. Rowe Price, there's no secret, they're very prominent in the target date space. We replaced
And we go to the SSI fund.
Yeah.
5-year we were on.
Yep, and so you see the rankings are superb on page 31. Now, if you go into recession, the S&P is down 30%. These equity heavy funds will probably, be affected for sure, but the wave is up right now. We can ride it. So, going down, large value, Hartford dividend value, very nice rankings. And large core, Hartford capital appreciation, you can disregard the 8, 7, and 54 because it was replaced with Oppenheimer Main Street. In the large growth category, Mass Mutual Select Ops is on watch.
Gotta be better choices.
It is on watch, and so 2 quarters ago on the 5-year, it was ranked 33rd. It dropped to 40 last quarter. Now it's dropped to 72nd.
I'm gonna drop from 30 to 70 on a 5-year average in 2 quarters.
Yeah, it's very, very easy to do.
2 quarters on a 5-year average.
Yes, because this data, if you have a, really polarizing quarter or a couple of quarters in a row, it very quickly rolls up and it affects the 3 and 5 year.
I mean, you're talking 20 quarters in the 5 years, you drop off 2, that's.
And also the success of other, isn't it also could be
Well,
the success
it
of
can.
others as well?
Yeah, yeah, so if you, this might be interesting. Yeah, so if you were to go to page 46, and you look at the Hartford Capital Appreciation Fund, I beg your pardon, Mass Mutual Select Ops. There it is. You see for the 3 months, down 6% compared to the median in the category, down 27 basis points. And then go to 1 year, down 666. Just having awful comparisons against the Russell 1000 growth, but in this category, the large growth category, median 3 1/4. And the 3 year, down 227 compared to those other numbers, very quickly rolls up and, can affect the rankings as we're saying. Anyway, so if we do continue the discussion about expanding the investment policy monitoring criteria, it would be interesting to see how a fund like this would hold up with those other metrics.
And that's the only large cap growth fund we have.
Yes.
I should at least think about the second one, what choice in this bud and nothing. You generally have just several categories with one fund in them, or?
Yes, and that is, now, Gary, every committee has its own, preferences. And I'm here to, to serve in that regard. I can tell you that the industry trends out there and best practices are to have a reduction of funds, much leaner and cleaner. And when you consider that a new hire here, other than firefighters, first has to select what record keeper they're going to, sign up with, and maybe it's a function of what education specialist gets to first. Then they have to determine an asset allocation, and so if they determine an element of large growth,
I totally appreciate that.
yeah, so.
You got 3 large blends and only 1 large growth.
Freddie, when I
Well,
sent that email
no,
out to
no,
you
no.
earlier, Henderson had like a page and a half of funds. How does that comport with what you're doing with us relative to what you're advising them to do, or they're just not taking your advice?
Oh, no, that's a very good question. City Henderson's my client. City Henderson is almost a blueprint carbon copy of Vegas. I just started with them. So just when I started with Vegas, it was all of this. Now we've got it, what's manageable. So they're just,
So they had even more funds prior to that list that I had emailed?
Pardon me?
They had even more funds prior to that list?
Well, that was pretty much the start of it. That's pretty much what I inherited.
Oh, gotcha.
Thinning it out. No, in the large blend category, there's one active large blend fund, and then there's one S&P 500 fund. And that's the intent.
That's the Oppenheimer, it's the Hartford cap, you got rid of the cap appreciation.
Correct. And, the methodology behind that is that, if anybody, if you look at an asset allocation model, whatever exposure, to equities, we know large cap is going to always be very well represented there. And the configuration of having, an active blend fund and an S&P 500 fund and an active value and active growth is if somebody wants to have less fees and just index all their large cap exposure, they can put it all in the S&P 500. They can put a third, or they can, have active growth and active value. So that, that's the methodology behind that.
Real quick, Gary, on the large blend, it says 3, but the Hartford.
Yeah, I picked up on that, I don't know if it's gone.
Yeah, and then also, one of the things that we did has shown a trend that there was not a lot of movement from the participants, from the employees, of making any changes and things like that. So having all of those choices, really, they were just sitting because no one was even touching their plans. We did try to go through education so that people would get more involved. What did we call that? Something Palooza.
Oh, there was a big education.
Yeah, we did a big
Okay.
education. Benefits
Palooza,
Palooza,
yeah.
and part of it was this. So I think that's some of the reasons we have gotten down to it's so lean on our choices.
Right. And there's yet another agenda item that we're gonna revisit that as a fiduciary exercise and look at the asset classification we have. Okay, so where were we here? Okay, so, let's see, look back at one thing here. Yeah, so that is on watch. It was put on watch last quarter. So it's been on watch 1 quarter. The general procedure would be keeping on watch for a couple of quarters to see if it can improve. And I would offer that next quarter, prior to me coming here, if it's still below the 50 percentile, 3 and 5, I will be prepared to present an answer search. Does that sound good?
Do you know anything about what's causing the bad performance? Does it have a new manager? Some sectors they invested in that they outside the style of auction?
I haven't really looked into attribution, to be honest with you. I certainly can. And, maybe next quarter, if it is gonna be replaced, I can, offer that. And if the attribution is acceptable and you wanna keep it on watch, to monitor trend, we can certainly do that. Okay, page 32. There's our mid-cap value category, Hotchkiss and Wiley. It is on watch. Last quarter, it was ranked 90th on the 3-year. It improved to 78th, still not in compliance. However, on the 5-year, it's stellar. Last quarter it was second. This quarter it's remained at second percentile. And so, the reality is by investment policy criteria, it's in our document, you don't have to be above 50 for 3 and 5, only one of the two. But the committee decided to put it on watch because of now the 4 straight quarters below the 50th percentile on the 3-year. I'm not necessarily in favor of that approach because it's still stellar on 5-year. But I was asked to prepare a fund search, and I will take you through the fund search, and then you can decide if you want to replace it or keep it on watch on the basis of the very good 5-year ranking.
I think I remember from your earlier slide, it was like the top performer of all funds for the last 12 months.
Yeah, well, the main reason is the category is done well, mid-value. So would you like to see the fund search? Do that? Okay. You see below the funds for consideration, you've got Alliance Bernstein Discovery, MFS Mid-Value, Victory, and Wells. And if you go to page 46. see so we'll go from left to right. You see for the quarter, Hotchkiss and Wiley did have a very good quarter, up 12%. Over 1 year period, Alliance Bernstein. Yeah, down at the bottom. The
Second line, the bottom.
Okay.
Yeah, and this will continue on the next page, but again, the fund in black is the incumbent fund, the funds in blue are for consideration. So over a 1 year period, Alliance Bernstein is the best at up 24.38. On the next page, on the 3 year, Victory is the best at 10.78. And on the 5 year, going back to page 46, Hotchkiss and Wiley is the best, and not surprising given its superb ranking for 5 years, second percentile. On page 46, the 1 year ranking, although not an IPS criteria, Alliance Bernstein is the best at the 8th percentile. On page 47, Victory is the best at 6th percentile, or excuse me, ranks 6th in the category for 3 years. And on page 46, again, Hotchkiss and Wiley ranked 2nd percentile. On page 47, there's our risk measures to the right. Wells Fargo has the highest alpha at 142. Victory and Wells Fargo have the lowest beta at 0.95. Wells has the highest Sharpe ratio at 145, the lowest standard deviation. If you go to page 54, there are the annual returns. And last year, Alliance Bernstein was up 24.38. 2015, Victory was up 68 basis points. 2014, Hotchkiss and Wiley and Victory were both up 11.90. 2013, Hotchkiss and Wiley 42%. 2012, Hotchkiss and Wiley up 30%. 2011, in a poor year, Victory was up 10 basis points. 2010, Hotchkiss and Wiley was up 34%. 2009, Hotchkiss and Wiley was up 56%. And there's the polarizing year we always look at, 2008, preserving value on the downside, where Victory was down 29%. And the 2007 Victory. The last component of this is if you go look at the fees and expenses on page 60. You see the incumbent fund, Hotchkiss and Wiley, is the most expensive. Victory is the least expensive at 99 basis points. So,
do the Morningstar star ratings for these ones?
yeah, they're in this booklet, and the star rankings we can reference. It's not a criteria we've used, but it is in the reporting document. If you look on page 36. And 37. And so on a 5-year basis, Hotchkiss and Wiley is a 4-star. Alliance Bernstein is 4-star. MFS is 4-star. Page 37, Victory's 4-star. Wells Fargo's 5-star.
I tend to like 5-star ones, just in general.
Yeah. It's interesting. A lot of these metrics are kind of tied together, and then if you get a lot of the same, the metrics consistent.
To get a Morningstar 5-star rating, you have to look at all of those things.
Yeah, right.
The alpha ratio,
It all,
that stuff.
yeah. So anyway, this is open for discussion, and like I said, the committee placed this fund on watch due to the 3-year ranking, but in fact it's superb on the 5. there are suitable replacements, but you may want to consider, is a replacement necessary?
Put it in the, so wells on the 5 is ranked number 5, but this is 8, the 1,000, you know, 5.
It's a five, on the 5 year.
Yeah, 5.
Yeah, 5.
We're pretty good in 3 at 5-star rated funds.
The return over the last year is still high, or in the last 3 months as well.
They're all pretty good.
Yeah.
So,
And that's noted, but you know, that's probably the least weighted, the least weighting.
correct.
Yeah.
And if I was thinking about, you know, where it's really trending,
When
I
you-
should take that out of the.
When you switch funds, you like automatically map people who choose to do nothing to move them.
Yes, yeah, there's a 30-day notice sent out, required 30-day notice, mapping notice, they can, you know, opt out of it, step aside if they want, which rarely happens.
Most people just let it come out of it.
Yeah. And why shouldn't they if they've already, you know, made a decision to have that exposure in the asset class?
Flip back to 40 seconds.
Yeah,
Okay, so the fund that we're talking about getting rid of did 12% in the last quarter, almost 21% in the last year.
Yeah.
Just thinking about how you explain to somebody who just made a 21%
Yeah.
return that we got rid of their fund.
That's not there anymore.
Yeah.
I don't wanna do that. I'm in
We
this
got rid of it, we
side.
traded it for 24% longer.
Yeah.
And the whole category, yeah, it's like me.
That's right. And so you know,
That goes to your point, you were gonna recommend not doing anything, right?
yeah,
Your
because
original comments were headed that way, I think.
that's correct, and you know, it's been my observation that, you know, you're very much in compliance with the investment policy statement, but there are times when, you know, based on some kind of a polarizing observation, you know, really good or really bad in a short time period, a committee member might tend to, you know, get a little jumpy and make a motion that, you know, put something on watch, and this is the subjective part of it, because it's stellar on the 5 year, and I think you could certainly rationalize keeping this fund on watch on the basis of its stellar 5 year. Don't take it off watch, but keep it on watch because it still is under pressure for 3 year.
So it must have, I mean, maybe I'm not getting it, but on the math of how you would get bad 3 year, 1 year is 31st percentile, so the bad part must be in year 2 or year 3 to get that bad on the 3 year ranking.
Yeah.
So I'm surprised that it wasn't already up in the 60s or 70s, or certainly above your benchmark in the previous quarter.
Yeah, well,
well, if you also go back to, I think it was, the one that shows the years, is 54. Or the
yeah, the individual calendar years.
Yeah, so you have, like in 11,
15 of all, 12.7 bucks. So 15 was really good.
And I'll tell you, you know, another.
5 years stronger than about 42%.
Yeah, look at that 13.
And, you know, a 1 year ranking of 31, you know, benefiting from the very good year, which did, you know, improve the 3 year ranking. So again, you could rationalize, you know, keeping on the watch, not just on the basis of the great 5 year ranking, but also on the trend for 1 year.
now, just in discussion, what about in this particular case, we would add one of these and then put notification out and let the participants in this, let them know that it's out there and that they can choose if we're having.
It looks like your strategy is not basically one fund strategy.
Yeah. That's an interesting would be in favor of it, because again, it creates confusion for the participants.
We don't have a lot of money in this one, correct?
Looks like there should have been a lot of money in that. Wish I had all my money in that category.
And-
Even with the 12.
Yeah, and,
Just not in 2015.
No,
yeah,
not 2015.
yeah, there's 416,000 in it. Yeah, you know, small value as a category in mass allocation isn't gonna attract, you know, huge amounts usually, you know, not like the large caps.
This is mid.
Yeah, that's mid-value.
Well, if we look at 12, if we look at 11, 12, and 13, we had a really bad 11, a great 12, and a better 13. So everybody move your funds over, because 17 should be great. It happens the same way. We had a bad
Yeah.
14, a bad 15, a good 16, so we should have a better 17, and then take it all out.
If you kind of compare the funds over the Russell benchmark line, you can kind of see how they do compare the benchmark each year.
Yeah.
Do the same thing, you know,
So even though 20.7 sounds pretty good, it's just barely above that benchmark of 20%.
Yeah, you know, it's been very difficult for active managed funds to beat benchmarks, you know, in the last year.
Or index funds can pay off over long term.
Yeah.
We could have that debate for every meeting.
That'd be a lesson.
John, you've been a little quiet on this one over there.
I do want to avoid the fund bloat, you know, the multiple funds and families, especially if we have index funds. Actively managed, you can make the argument that, you know, certain active managers take a different role even though they're the same category. You could consider two funds and two actively managed funds. I don't see the advantage of having two index.
Well, this is an actively managed.
Yeah, I know.
Yeah.
I'm just saying that as an actively managed fund, I could see having a second one added or.
Yeah.
Do we have participants that have money in both not mutual and IC?
Yes, primarily to get the 4% in the fixed and mass. Not a bad option when you consider there's no interest rate risk in that fund.
Right.
And
You know.
it picks up on the annual cap, so it doesn't allow for overage anyway.
You can technically be in all three, right? And
If
if
you're
you're a fire,
firefighter.
you could be in
Yes.
yeah.
Yeah.
We could get smart money to pick up on contributions to other states.
Did we get Luke, John?
The IRS would.
Oh, okay.
and still voting.
Somebody.
So I'll tell you what makes this discussion somewhat of a challenge is that, number one, in my view, there's no foregone conclusion that the fund needs to be replaced. That's one thing. The other thing is, your replacements, they're all very good choices.
Yeah.
It's kind of hard to choose between those three.
Do you know anything about the managers in these funds? Do they have long tenures?
Yeah, they have to have long tenure to even be on this list. For Morgan Stanley being a co-fiduciary 321 on. It has to go through our internal screens to even be
To
approved.
be on your recommendation?
Yes.
But the ones that are long tenured funds that before you started, I don't know how long you've had options. I never heard of options before. I don't know how long you've had it, but you know, anything about the fund management for that fund?
You know, not intimately, but on the fund fact sheets, you'll see that it does show manager tenure, which is significant. Go to page. Yeah, so if you go to page 80, the average manager tenure is 19 years.
Pretty well.
Yeah. I'll move all my stuff over there for you guys. I'll move all my stuff over
And
there.
you'll share.
Talk to me in a year.
And we'll share.
Yeah.
It's taken a long
For the
time.
Don't disrupt the allocation.
Yeah. Oh,
The thing that makes me a little bit concerned about it is it doesn't seem to be consistent. When you look at the 1, 3, 5, 10 year, I mean, it seems to be up and down. So that would imply to me that the fund managers are a little bit outside the style block compared to benchmark.
Well, yeah, so if you look at the R squared of 78, that is, kind of below that 80 threshold. And R squared, for everybody's recollection, is the higher the R squared, the index itself would have an R squared of 1 to itself. The higher, closer it is to 1, the more style pure the actively managed fund is. In other words, how much the index itself could be responsible for the returns. Now, on the other hand, if you have an active fund manager that has an R score of 99, you might say, this active manager is a closet indexer, and we're paying active managed fee while we just get an index fund. And that's a good point of the 78, because in one of the 12 data points of what could be an evolution, in the criteria, it would be closer to that 80 threshold as one of the 12 data points per style period.
We're going to see, in one of the next quarters, we're going to see probably a big jump in the 3-year ranking and, a little dip in the 5-year.
If this trend continues, yeah.
Well, more than most likely, only because of the fact that 15 is going to start bleeding over into the other quarter. So we don't have a breakdown of each quarter for the last 5 years, but just looking at it, we're going to see it going over to the 5-year and moving. And so that's just going to make those numbers change.
And we've got a lot of room to get back on the 5-year,
Right.
based on we're already at the second quintile,
Correct.
or second percentile, yeah.
For kicks on the Wells Fargo, do you know that R score?
Wells is 92.67. Yeah. And, Wells has a beautiful Sharpe ratio. Look, a beautiful line items of high alpha, low beta, high Sharpe ratio, low standard deviation, and a nice R squared.
If I was going to choose one, that would be one that intrigued me. I can understand the reluctance to get rid of a fund that did have a good year. But it is a 3-star. I generally try to get rid of 3-star rated funds, move up to 4 and 5-star rated funds. If you don't look at star ratings, it's not like very much.
I'm not opposed to it, but, the star ratings, of all the funds in the category, the funds in the top decile, 10th percentile and higher get a 1-star, and then it drops down from there. That's how the star ratings. And there's a certain school of thought that the Morningstar ratings is more for the masses, more for kind of a retail audience. Not that there's easy to understand, and it's not a very academic approach, but when you have access to more data that you can analyze and look at the quantify the risk measures, and if all those things, of decent returns, consistency, high alpha, low beta, risk adjusted Sharpe ratio, all those things are good, they're going to distill themselves out into a 4 or 5-star fund. There's nothing wrong with the star rating, but it's not something that at this point, it's not in my 12 criteria. If the committee wants to expand, I think we should. I get the sense you would be in favor of looking into that. But the thought was
something to look at. I don't know.
Yeah. Yeah, but the using the star rating as a criteria itself, we have not done that. So I
It's
think
not easier to explain to somebody who just has a life savings invested that you 4-star fund for 5-star fund, I'd like to explain that and explain to them that the R squared wasn't as good.
That's true. That's right. Yeah.
What?
Well, they might ask you, but how? Really?
But we looked at the Sharpe ratio.
Yeah.
And it was really
Oh,
bad.
yeah, okay.
They're not good.
Don't forget about the beta.
As long as you did that.
Yeah. So I think there would be, two viable considerations. A motion to, keep the fund on watch on the basis of its stellar 5-year ranking and improved 1-year trend that has improved the 3-year ranking. Keep it on watch on that basis, or to replace it with the Wells Fargo on the basis of its stellar rankings and gorgeous risk metrics.
Well, unless we're doing a motion to replace, we would need the motion to take it off watch, right? Because we don't have to make that motion to keep it on watch.
Well, that's true, but, yeah, well,
I would just say, leave it on watch, but just have these, unless someone we just want to replace, to replace.
How many quarters is that one? 2?
Three.
3?
Yeah, this would be the.
So is your
This would be-
policy of any automatic, get rid of it after so many quarters of one?
no, because there should be a little element of flexibility, subjectivity.
I think they've been on watch the last 2 quarters only because of,
Great.
right,
3-year ranking.
because of the 3 years.
John, any comments on your part back here?
Just listen.
Yeah. Okay.
These ones know this stuff, so.
Okay, does anybody want to make a motion to do anything with Hopkins and Water? Hearing none, we'll keep it on watch. Talk about it again next week. Come back to the other page where it shows the year by year with the ticker numbers. Someone wrote the tickers, WFPAX. Yeah, thanks.
Okay, I think that's a good decision. Continuing on page 32, in the mid-court, there's our State Street mid-cap index, ranked 6 and 11, beautiful. And the mid-cap growth fund, Hartford mid-cap HLS, ranked 6 and 2. Small value, investment small cap value has been on watch. 2 quarters ago on the 3-year is ranked 83rd. Last quarter it improved to 76. This quarter it's dropped to 78. Not in compliance with 3-year. On the 5-year has never been an issue. Although 2 quarters ago it was 55th. Last quarter improved to 16th. This quarter it's declined to 27. So no real issues on the 5-year, but on the 3-year, still under pressure. And so the funds for consideration, as you see, are American Century, MFS Discovery, Redeemed Small Cap, and Wells Fargo is showing up in the value category.
Hard to beat a 1 and a 2 on those 2 numbers up there.
Yeah.
It's impressive.
Yeah. Let's look at some metrics on page 47.
Solid.
And over the quarter, Nuveen was up 1492. This is a 31, so the year-to-date in 1 year is essentially the same observation. So looking at the 1 year, Nuveen wins at 31%. Over a 3-year period, tops at 12%. 5-year, 17. The rankings, 13, 1, and 2. Very strong metrics in terms of a high alpha of 273, beta of 97, Sharpe ratio of 122. It does come with a relatively high standard deviation. But you see MFS New Discovery also has very good risk measures, the highest alpha, low beta, highest Sharpe ratio, lowest standard deviation. Now, go to page 55. And there's the year-by-year comparisons. And last year, Nuveen was up 3116, 2015 up 295.
You beat the benchmark by 10%. That's unusual.
Yeah, yeah. 2014 Wells Fargo, 2013 Invesco, 44%. 2012 Invesco up 22.5%. 11 Nuveen up 25 basis points. 2010 Invesco up 29.53.
I think I've heard about this fund because we had it in my previous line on it, got replaced. It had fund manager change not couple of years ago?
Not that I'm aware of.
It's gone from riches to rags.
Yeah. Well, that's what a bad, year, like I said, a concentrated period will do, quickly in 3 and 5. But
Before that, yeah. The last 3 years,
average manager tenure 6.5 years on Invesco. But then again, 2008, a fund that's down 26%, and saved carnage in a down year. So.
Make a motion to replace Invesco small cap, Nuveen small cap.
Okay, motion on the table, is there a second?
I'll second that.
Discussion? How long have investors been on the stock,
Yeah, it's been on watch since
Has to be a while with those performance.
June of last year.
Freddie, it's been on the watch list because of just the 3-year, right?
That's correct. Yeah. Although 2 quarters ago, it was ranked 55th on the 5-year.
Yeah.
It was consent, yeah.
Okay.
Other thoughts or comments before we vote on the motion?
Well, I don't know if it's necessarily tied to the motion exactly, but I think that if we're looking at doing different metrics and adding in 12 more criteria and things, we need to talk about whether we want to adjust what goes on the watch list, just because if the watch list is supposed to be 3 and 5, and we start moving people because of just 3 or just 5, then maybe as a committee we need to change what our standard is for putting people on the watch list, and then taking them off and replacing them, because if we're supposed to do it just with the 3 and 5, but we start doing it on 3, then maybe we need to say that's going to be our, if either one falls below.
Couldn't everybody say it is it either one below 3 and 5 and 50%?
Yes, and you bring up a good comment, and what I would say is, the IPS is designed, at least on the criteria now, top 50 for 3 and 5 year, although not only one of the two has to comply, and then there are no hard and fast rules for manager termination. And, you can talk to a lot of risk attorneys, and I know RISA doesn't technically apply in the 457 world, but, best practice to, act like a fiduciary, have a plan. And, most of your risk attorneys would say you want to have a document that you can live by, but not so strict that, you're going to be in violation of it. And so that allows a committee to engage in these discussions, to vet it, look at, trends, short term that might affect long term, market conditions, and, give you that element of subjectivity in it.
But also,
Yeah.
our plan only says that consent is below 50. We can put anything on the watch list.
Okay.
That we want, whether it's based off of 3 or 5, or if we just want to.
Just because?
Just because, we can put anything on the watch list. We don't have to replace anything on the watch list. We can replace any item, even if it's not on the watch list. If something's happening, or we think that something's going to happen, it doesn't even have to be on the watch list to do this. This just makes it easier to manage. We put it on the watch list to see what's going on, see if trends.
Yeah.
And in many cases, I think we have removed things off of the watch list because they started improving and not doing a replacement.
Right.
So we still have all of that flexibility to do.
That's correct. So there was you did make a motion to replace Invesco with Wells. It hasn't
No,
been,
with Nuveen.
excuse me, with Nuveen. It hasn't been voted yet.
It was second. but-
There was second.
We had discussed.
We're discussing.
Yeah.
Discussing.
We're in discussion.
Yes.
So, the star ratings on UV, is it 5 right now? Oh, yeah. Yeah, 5, so,
No, it's close though.
And remember, only 10% of all funds, get that 5 stars.
Right.
Yeah.
What page is it on?
The star rankings? It is on, we rarely look at it at the start. Yeah.
Oh, it's, no,
Yeah.
earlier.
Yeah, it's on page 37.
Oh.
And Nuveen, for 5 yard, is a 5-star fund for overall green fund. Again, it's no secret, no surprise that with all those good metrics, it distills out into a 5-star fund.
You perform good, you get high star ratings.
Fair.
Yeah.
Tough but fair.
And that's what it used to be too. For the 3 years. Yeah.
Okay.
We got one that.
Are we ready to vote?
Yes.
Okay, all in favor of replacing Invesco with Nuveen, say aye.
Aye.
Opposed? Passes unanimously.
All right. Beautiful. Continuing on page 33. In the small core category, AMG Manager Skyline is not in compliance over 3 years. 2 quarters ago, it was ranked 43rd. It dropped to 70th. This quarter did improve to 59th. However, on the 5-year, 2 quarters ago, it was ranked 5th. Last quarter was 10th. This quarter improved to 6th. And here's a situation where it would be a good idea to look at the quarter and the 1-year performance on page 48. And again, stress, so on the 3-year last 2 quarters, although it did improve from 70 to 59, and it's no secret when you consider on page 48 that for the quarter the fund was up 1488. The 1 year was up at 21.32, outperforming the median return of the category of 20.78 and the benchmark. And over the 1 year period, it ranks in the 44th percentile.
So it's been at or above the benchmark pretty much every quarter.
Yeah.
Every period on there.
Yeah. So, again, it has a very good 1 year trend. And I think it
So
would.
did we put it on the watch list last quarter after it dipped below?
No, it was not. Yeah, bring it to your attention. So again, similar to Hotchkiss and Wiley, it might show an element of discipline, not to have a quick trigger finger on this, and see if this trend will continue. Again, based on the stellar 5-year return and the strong trend over the last year that has affected the 3-year.
So this is one of those cases that we might want to look and see if we want to put it on watch.
Right.
You got it.
Got it.
And you could also do that. But in doing so, acknowledge the very strong 1 year trend too.
What do you want to do, John?
Yeah. You can put it on watch list, I guess.
Do we need the chairman here to make a motion to put that on?
I don't believe you need the chairman, if there's enough people in the room to cast the vote.
We have four. So we keep moving. I make a motion to put A&G on watch.
I'll second. Since John already made the motion.
All in favor?
All in favor? Aye.
Aye.
John?
Yeah.
Aye, okay.
Silence is consent.
They got negative consent, like, okay.
And you already presented these other two on consent, aren't you, correct?
Actually, well, State Street Small Cap Index is fine. Hartford Small Company Fund has been replaced by Investo. Franklin Utilities is fine. Hartford Healthcare is fine, and American Century Real Estate, as previously indicated, is on consent watch. And so, large foreign blend international stock, very strong rankings, MFS International, Hartford Global Growth. And that completes the review for Mass Mutual.
Good, we have 2 more.
2 more.
Yeah.
Not only that, we have, back to the agenda.
Liquidity restrictions?
Yeah, so, so first for liquidity restrictions. So there is this attachment, Jim?
Yeah, I don't know if they're pulling money out without notice, that's fine.
No, so the general account, you know, the 4% crediting rate has always been, you know, Mass Mutual's, you know, wild card. And, it's presented certain challenges and,
What is that?
What was it called?
it's, I can't remember what we called it. But,
No,
Investment policy?
no.
Must be one of the ones that
these
said.
are the
Mass
last two
Mutual.
you sent me.
12 what, there it is.
Oh, like that.
Yeah.
There we go.
Yeah, and so- Last quarter, Julie, you know, with Mass Mutual, City of Las Vegas is still on the old Hartford record keeping platform. And it's kind of an antiquated, you know, old family station wagon, if you will. The investment fund platform has some restrictions. It's not the most robust record-keeping platform, and if you ever would leave Mass Mutual or leave that platform to go to an upgraded platform, you'd have to deal with what liquidity restrictions come with the general account. And this is a letter dating back to 2011 that initially, when the contract was signed, it came with a market rate adjustment, and in 2001, it was agreed to go to a 12-month put structure where if you were to leave Mass Mutual, you are to pay your consolidation of the record keep, whatever the case may be. The $70 million or so in the general account would essentially have to stay behind at Mass Mutual. And in the new record keeper, and any participants can still allocate money to whatever the stable value option is in that new configuration. Now, on their statement, it would still show up as a line item of assets in the general account, kept at Mass Mutual. It would still be benefit responsive, meaning that if a participant wanted to take a loan against it, or was terminated, they could still, you know, get the money out of it. And this type of thing is not egregious by any means. This is kind of how the industry works. I just went to real estate casinos, we bought the Palms, and there's a few $1 million in the general account. With the principal, station uses Transamerica, and so the money in that fixed fund is staying back with the 12-month period. That's essentially what this is. So Julie Hiddle asked me to clarify what this is, and I've done that in this letter. She had also asked, and she represents the Employees Association, is that correct?
Yes.
Yeah. And so she had asked, to verify what funds have certain balances and, how many, different people are in that fixed account and all the other funds, and that's what, there's another attachment of, investment balances. And I think that your intention in requesting this to find out if there would be a reason to bust loose from Mass Mutual, how many people of hers would be affected. She says, can you sort it by bargaining group? And Mass Mutual does not have the ability to do that. So, as a close second, at least it shows the breakdown of 50 and older, terminated. You can conclude that those are, probably the retirees. With about 38 million in the general account. And, other than showing this in the context of Julie's request, there isn't really a whole lot more I can say about this data. But it's here. She can look at it as one of the attachments in the Dropbox, and we can have it to reference in future meetings. I don't really know what else to say unless anybody else has any questions or comments. Okay? Okay, now finally the benchmark reports. All right, so Mass Mutual, the way they give the information to Fiduciary Benchmarks, who's the company, the independent third-party company that Morgan Stanley contracts with, we consider them a preeminent industry leader in collecting data through extensive surveys, categorizing, retirement plan business. And the way Mass Mutual reports is they have a separate report for the 457 and the 401A. So on the 457, yeah. Yeah, and so you notice, we're gonna look at that, but not just yet. There. All right, so you notice on the left panel that this report basically has 3 chapters. And I will take you through this, high level, unless anybody has any questions now or for follow-up. But essentially, we'll look at the total plan fees, which is in this report is the fund manager fees and the record keeper fees. So if you go to page 2, now this is, we've done benchmark reports for City of Las Vegas before. This is a new format, and so Fiduciary Benchmarks, this is like the next evolution of their reporting that they think is more comprehensive. And for these different chapters, the process is, and again, the backdrop is that ERISA requires fiduciaries to make sure they only pay reasonable expenses to service providers and fund managers. Note the Department of Labor does not provide specific definition of the term reasonable. Instead, they wish each fiduciary to make that determination based on data from the service provider or fund manager. Don't consider fees in a vacuum. They're only one part of the bigger picture, including investment risk and returns and the extent and quality of the service provided. So the emphasis here is the Department of Labor puts the onus on plan sponsors to have a means to determine if the fees they're paying are fair and reasonable. It's a very, very important fiduciary act. The way to only do that is to have a means to benchmark your plan against other plans of similar size and scope. And so fiduciary benchmarks process is first they establish a customized benchmark group, then they review the quality that you're getting from the service provider, they assess the scope of services, they then determine the value and in terms of evaluating the fees. So if you go to page 3.
We're evaluating the plan provider in total?
Well, yes, in 2 aspects. The cost of the investments and the cost of the record keeping. And so if you go on page 3, these are the total plan fees. And you see that the total plan fees are 39.6 basis points on the top left. And the way that is divided is that 24 basis points are retained by the investment manager. And remember, just going to get back to our original discussions on this, is that the fees generated in the plan, from a top line revenue generation, you have the fund expense ratios, okay? And then from that expense ratio, part of it is retained by the investment manager where you can get paid. And then a certain element of the expense ratio is revenue share per fund for the record keeper. Now you see on this down below, other fees, total advisor consultant fee, there is nothing there, because again, this report is as of 12/31, but a year from now when we do it, there would be something representative. But my consultant fee is in the third report. So now over to the right, you see there where, let me stop for a second, because there's a lot to look at here. What we're doing is we're looking at the fees of your plan. We're comparing it to a benchmark group, okay? And then we're also comparing it to a proprietary representation of value that Fiduciary benchmark has. That's called the fee point. And so on the top right, the fund management expenses, the average fund, the fund manager on a weighted basis, they're keeping 24 basis points. The benchmark group is 26, so that looks cheap comparatively. And then fee point assigns a 26 basis points to the value. So on the surface, that looks fine. The record keeping, 15 basis points to Mass Mutual, and that's slightly less than the benchmark group, and the value is about that, so that's good. And so the total fees, 39 basis points, slightly lower than the benchmark group of 41, and where Fiduciary benchmark sees the value at 41. On the surface, that looks good. So this is the high-level overview. If you go to page 4, now here's where it gets a little dicey, because again, you have the general account situation, and you see at the top fund. Can you people see that from there? Can you make that bigger, Jennifer?
Well, if I do, it's gonna cut out.
You gotta scroll around them.
Okay, well, you see the 71 million in the general account, okay? And where it doesn't assign any costs associated with that fund, either to the investment manager or the record keeper. Does everybody see that?
It's smarter than everybody else.
Well, and so I looked at this and I spoke to Fiduciary benchmarks, and I said, I have to bring your attention to something that is different from what we're looking at. And the gentleman got back to me today. I said, why was it in 2012 we did this benchmark report? And, Mass Mutual gives us data to Fiduciary benchmarks. And, the general account, again, this is repetitive, but, it's not a registered fund. They're not required to give any transparency to it. It's the general account of the insurer, where, insurance policy owners and annuity investors pay premiums. Somebody, dies, they pay out the benefit. In the middle, they invest the money. So the 71 million City of Las Vegas is grouped in, lumped in with a bunch of other plan sponsors of Mass Mutual's book of business in this big, behemoth general account. And so it was Fiduciary benchmarks philosophy that, you can't, it's not fair for Mass Mutual to not represent any cost to this fund, either from investment management or record keeping. So Fiduciary benchmarks assigned a 65 basis point cost to the general account back in 2015. I don't know if anybody remembers that. You weren't here, John, but and so it was assigned to the record keeping cost, but it made the record keeping cost look high, and because it wasn't assigned to the investment management cost, it made the investment cost look very low. On a weighted basis, it's, half the assets are in that fund. So I said, what's the difference? Did you guys have some sort of a change, a paradigm shift in your methodology? And he sent this email today. Hi, Freddie. Following up on our conversation this morning, below is the response we received from MassMutual regarding the revenue sharing in the general account. For the city of Las Vegas, we assume no revenue from this is MassMutual's response. We assume no revenue from the general account, fixed account assets to offset record-keeping expenses. The city of Las Vegas has a 4% crediting rate. With the current agreement, the crediting rate will not fall below 4%. For that reason, fiduciary benchmarks do not include an associated expense for the general account in the benchmark report. That differs from the approach we took in late 2015 in the early benchmark report from the city of Las Vegas, in that MassMutual informed us that they would not disclose any revenue sharing details around the general account. For that reason, we opted to illustrate the average rate of revenue sharing based on data fiduciary benchmarks had historically collected about other general accounts, which was an average of 65 basis points. So, here's what I can tell you, that if you take, and I did the math, that because MassMutual says there is no revenue sharing that we get from the general account, and so ultimately, based on that, this makes these cost comparisons pretty favorable, okay? But the fact is that if you were to separate out the 71 million from the 144 million, and then you still take the record-keeping costs that is quantified as on page 3. If you take the money manager cost of $348,000, that really makes the record-keeping cost 48 basis points, not 24, and the record-keeping cost of $222,000 makes the record-keeping cost more like 30 basis points instead of 15, because essentially now you're taking the same revenue generation to cost, only applying to half the assets. Everybody understand that? So
Exact same situation though.
yeah, so again, that's the good, bad, and the ugly in having the 4% crediting rate. The other part of the plan is expensive, because that's what's supporting the 4% crediting rate. So
basically, the people that are investing outside the general account are paying the expenses of the general account participants.
I'm so glad you brought that up, because
Which the majority of our program retirees, right?
Pardon me?
Which the majority of our program.
Another way to look at it is, Vince is saying, is the actors are subsidizing the retirees.
Exactly right. And that dovetails into that whole, which
Although the
again,
actors probably earn more than 4%.
right. But that is a potential another fiduciary concern that should be addressed. Is that, and that's the policy of fee generation, and who's generating fees, were the people in the general account of free riding, enjoying the benefits of the 4%, but not paying any of the plan revenue to support the plan, with people in variable accounts through revenue sharing quantified in every fund are carrying the load.
We raised this exact same issue with the MassMutual reps who we reported it last week. Their answer was, we'd be happy to negotiate a new agreement with you. We move you over to the MassMutual platform where we can keep track of all that information, but keep in mind that we cannot get you any close to 4% general accounts.
Well, I'm glad you bring that knowledge, because that saves a lot of
I think their intention is not giving it to you is partly because they want people, their client base to slowly move over to the other platform and negotiate.
Yeah. So essentially, we use the term, they're holding you hostage by that 4%.
Don't be surprised if they show up one day and just say, our board of directors won't let us do it anymore, we're done with our agreement, to move over to a new agreement.
Yeah,
And you basically said that it's the process, right? And they say that.
that's right. And I have another client that has a similar situation, different record keeper, with a 3% crediting rate that is still very attractive in this low rate environment. And what this record keeper is doing amongst their book of business is they're going to imposing a soft freeze and letting the people that are enjoying that 3% crediting rate keep it, but any new inflows and that they'll still accrue at 3%, but they can't add to it, and any money going to a fixed account going forward would be at 175. But anyway, but this topic of the free riders versus who's paying for the plan dovetails into another fiduciary concern of fee policy, and that you do have choices. Not that a decision's made today, because this goes back to discussions. But what you could do is essentially take whatever the record-keeping revenue is on half the assets and divide it across all the participants and put the same hard dollar cost on every participant across the plan, or do it in the form of an asset-based fee. And that way, you would still be, you'd be taking the same revenue dollar amount, it's a quantifiable dollar amount, spreading it across all the participants to address the disparity of who's paying the expenses. And I know that's a deep level engagement between, Julie and, all the committee members, but, and again, we've had these conversations, they're all part and parcel of the bigger discussion of is 3 record keepers optimal, is 2 record keepers are optimal, and the fact that, you've got half of the plan assets with Mass Mutual driving all the decisions, but if you were to consolidate the 3 record keepers on a solid base of 240 million, let's say, that 70 million only becomes 30% of the assets. In that regard, you can't let the 30% whack the tail wagging the dog at the 70%, philosophically speaking. So
I was pretty surprised when I heard that you guys had 3 record keepers, 3 plans, because
everyone
it's a lot of work, plus you dilute your base, and the way to get better pricing is have a bigger base.
And there's another story to that too, so.
Yeah.
For the sake of time, we'll talk about it offline.
Yeah, and then your predecessor, Mark, made this exact same point. And, it's one thing to review funds and try to get the best funds, but I think from a top-down approach, the best way to affect the outcome is to have lower fees. But, there's a lot of headwinds of the 4%, but,
I mean, the time to really engage in this conversation, I guess, was the day that Mass Mutual walks in the door and said, I can't offer it to you anymore. That's what's forced the question.
yeah, that would make it a lot easier.
Because if we just ditched it now, I mean, we have a irate number of people that are retired.
That's right.
That love the 4%, they want to just live on 4% all year, and they're happy.
That's correct. So anyway, back to the benchmark report.
Well, inflation is up to 6, and they won't be happy.
On page, so you go to page 6, and for the investment managers, this is the benchmark group, where the third line, you've got 163 fund companies that make up 2,144 funds. And the record keepers, there's 56 record keepers, which in this benchmark group, 14 are insurance companies, of which Mass Mutual is one of those 14. If you go to page 8, you're looking at the scope of services from the investment managers. This just shows you on the left that the target 8 funds, you see that about 75% are active, only 25% are index funds, passively managed. On the top right, it quantifies 30 funds in this lineup, but in the consultant fraternity, we would really the 30 funds is counting every target 8 fund as one fund, when in reality the series of target 8 funds is really more like one fund. And then in the middle, there's the 50% in stable value within Mass Mutual. Page 10. In terms of the fees,
Freddie, on that plan allocation, why do you think our allocation in the cash table is so much higher than the average plan? Are they not offering that?
Oh, the allocation's higher because Mass Mutual's getting 4% rating.
I'm saying they're not offering that to most other plans.
Oh my gosh, no.
I mean,
No, it's not a profitable proposition for them because, you know, that account, you know, the 10-year treasury days I haven't looked at it today, but it's probably around somewhere between 230 and 240. And then you know, spread credit risk bonds a little higher than that. You know, Mass Mutual may not even earn 4% in that general account, you know, based on, you know, they're all pretty good credit quality. And so amongst all their book of business, if they have to give, you know, City of Wichita 2%, you know, it's probable because they could keep that spread, whatever they're earning. But if they have to give out 4%, that's not a winning proposition for Mass Mutual.
Unless they're taking their cash from their insurance purchases and buying junk bonds with it and then earning 6 and turning around and
well, that's what I'm saying.
Yeah,
If
there's a little
You
allocation.
don't know.
You don't know.
their investments should return internally on average more than 4%. To get 4% money,
they've been saying that they're not, right? It's just in their story. We're losing money.
Well, they couch it.
Yeah.
They really tell us they can't do it.
Yeah, and you know, the low interest rate environment, blah, 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 but, you know, there is some, below investment grade, a little bit in their portfolio. We saw in capital market overviews, how well high yield did.
We have a high yield bond fund in our lineup too, that's one bond fund.
Yeah.
okay.
But
Thanks.
we earned, what, 8 or 9% last year? It's
Yeah.
doing pretty well.
So on page 10, in the middle, you can see that, you know, of the 30 funds, 18 are, you know, ranked 50 percentile or lower in terms of cost, so that's good. By total expense ratio, but then the money manager, what they're retaining, tends to be a little higher on the bar chart on the right. And then, anyway, just going down, just a quick explanation, you see, let's talk about, you know, the PIMCO Real Return Fund, for instance, total expense ratio 70, the 50 percentile is 50 basis points, so they're, you know, 20 basis point higher. Everybody see that in terms of the total expenses, and then what the money managers are keeping. Money manager keeps 45 of that 70, the median is 27, 50th percentile, so they're 18 basis points higher. So that's just an explanation of how this works.
I don't remember the exact numbers, but my last city when we got big enough, we asked them to entertain giving us better share classes, which have lower expense ratios.
Yeah.
Lower money management fees and stuff, and we were successful in moving up 1 or 2 share classes, and a lot of our fund on that. I don't know if we're big enough. I mean, my last city we were 250 million, and we only had Mass Mutual. We were all
Yeah.
Mass Mutual.
Yeah, that is an exercise that is the next wave of seeing if we can, you know, and I'm mindful of it. Not to mention, even more polarizing, that concept of being on a consolidated basis, particularly in index funds.
I don't know if Mass Mutual's getting kickbacks from some of these money manager fees, or, you know, what they're getting from us. I don't really understand how they really negotiate some of that.
Well, they do negotiate it in terms of the revenue sharing, because, you know, it starts with the fund companies that have, you know, top line expense ratios, and then it's up to the record keeping company to negotiate how much revenue sharing they get proportionally from you know, how expensive the top line expense ratio is. But if you look at page 11, most of the where slightly higher money management fees are coming from is from the T. Rowe Price funds. And so then the question is, you know, are you getting value for a slight premium in cost? And we can certainly say yes as it relates to the T. Rowe Price funds. If you go to page 12, so this is just a summary, basically summarizing what we just looked at. So that's the money management fees. Now if you go to page 13, now is the chapter for the record keeper. And, you know, there's that high average account balance of 99,000. In this benchmark group of the record keeper, there's 35 plans across 18 record keepers. And if you go to page 15, here's where the record keepers have responded to fiduciary benchmarks and checked the boxes of services that they're actually providing for the city of Las Vegas. And in doing so, we can assess the scope of services that they're delivering. And so on the core services, which you see down, you know, of what they do in the record keeping, you know, they have 24% higher score than the benchmark group. Administration, slightly less. Now, Vince, processing participant loans. In a perfect world, they would be doing that.
On our new platform.
Okay, on the new, with no, you know, to keep you out of that exercise. I wouldn't a sunshiny day be a record keeper that you could totally outsource those types of things. Now, with the compliance and testing, it's no secret that they wouldn't be doing the forfeit, the ERISA account, ADP, because that's not required in the government space. So naturally, they're not going to score there well. But where they do shine, where all these record keepers do shine, it's important. And I've said that the city has it really good in terms of the education, because not only record keepers have these assigned reps, but they all live in town and cover Vegas pretty well. Firefighters, you guys love to so they, you know, do shine, and they would, you know, in this regard, maybe, deserve a premium. And so on the top, or on the right, you know, they check group meetings, one-on-one meetings. Then if you go to page 17, down below, it says one-on-one meetings, one. And I don't know why they didn't, this would have been a chance for Mass Fiduciary to really shine in terms of the education that would have projected a higher fee point value. And they didn't do that for whatever reason. But the record keeping fees, again, with the asterisk that they're artificially low because of no cost associated with the general account. Coming in at 15.4 basis points, which is below the 25th and 50th percentile, which is good. And so in this illustration, they're pretty much on par with the fee point that the value that FBI would assign. So 18, in summary, record keeping, they have a high score. Administration, not as high. Scope of services, low score. Education, a high score, and that's a summary. Pretty in line with the fee point. So if you want to conclude for the minutes to reflect, is there a cost, investment management fees, and record keeping very reasonable for what's delivered? I believe it is, with the asterisk. You've got to consider, the inefficiencies of the general account situation.
How long has it been since the contract was negotiated? Long time ago.
Yes, as far as I know,
It's an evergreen.
it is an
old Hartford
it's
contract.
exactly what it is. The only alteration that I'm aware of was the letter of 2001 that changed the liquidity on the general account from the market value adjustment to the 12-month float. So that's the 457.
Would you call what you just presented pricing review?
It's a benchmark report.
Benchmark?
Yeah, benchmark report. Very, very important to do. It's a best practice for sure. That's why we do it about every year.
It's different than what you might get out of hiring a pricing consultant?
Hiring a pricing
To
consultant.
go through your plan provisions and give you guidance on whether you're getting a deal or should go out to the market and do an RFP or something?
Well, if that's the case,
Highest group or something
yeah,
like
you
that.
could. Well, highest group's a competitor of mine.
Yeah.
You could call me the pricing consultant. And really, if you put what you said in the context of the Fiduciary Act, the benchmark report is just that. Now, what I can tell you, Gary, is that, you know, any time that I enter a new relationship, I start with a benchmark report. And we did that for the city in 2015. And so you've got three different record keepers. Now, it's no surprise that, Mass Mutual, the highest asset base, should have the lowest fees. ICNA should be second. And Nationwide, with the smallest assets, the firefighters should be the most expensive. And they were, and so we did do the benchmark report, and the point is, it's an X-ray. There's nowhere to hide. It's going to expose any inefficiencies. And Nationwide, the fact is we did negotiate to get the lower fees from the benchmark report, and they've lowered it from 44 basis points to 30 in their record keeping. So, the 401A report, and this will be much quicker. If you go to page 3, and here's where the 401A. You ever
See,
see
it's
that?
page 4. Yeah.
Oh, okay.
That's okay.
Okay.
PDF one
Keep
page
up.
different.
Yeah.
Yeah.
That's right.
Thank you. So here, this plan looks very cheap. And the reason why, you see the total fees of 37.9 basis points compared to the benchmark group at 63 and fee point at 70. Very simple explanation is that fiduciary benchmarks here in this 401A, there's $9 million. So it's benchmark against other groups that are 9 million, but it gets the benefit of being lumped in with the large 457 plan because it does have the same fees as 457. And so, if you go to page
So these are just appointed as
Appointed executives, yes.
yeah.
That's
And on those that are putting at least the 2%, like to get 2%.
So if you go to page, in a nutshell, if you go to page 17, the record keeper fees are 15.5 basis points, which is cheaper than the 25th percentile. Only because the 401A is getting the benefit of the pricing of 457. Does everybody understand that?
Is it the exact same fund lineup as the other two?
Yeah. And so that's, in a nutshell, what I can tell you about the 401A. Last with Mass Mutual is the advisor. This is me now. And so if you start on page 5, and this is a questionnaire that I filled out. for fiduciary benchmarks. Your scope of services, it's saying I do 5% less investment services. Although vendor review services significantly more, and plan support significantly more. And all the boxes that are checked are boxes that tasks that I represented that I perform. And so on page 7, and so the annual fee that City of Las Vegas pays to Morgan Stanley is $105,000. And the way we allocate that 105 is proportionally across the size of the 3 record keepers. So the 105, 70,000 is coming from Mass Mutual, which accounts for 4.6 basis points. And so here, if the 50th percentile is 4.3 basis points, I'm earning 4.6, which is fractionally higher than the 50th percentile. However, on fiduciary benchmarks proprietary fee point, they say I'm worth 5.6 basis points. But I'm happy with 4.6. And so in a nutshell, that's my benchmark report for my fees. Now when I get into, it's hard to believe we still have the ICMA nationwide review.
Should be quicker though, right?
Should be quicker.
You write down the economic update.
Right. You know, 3 record keepers, a lot of stuff. But when we get into just a sidebar of the 105,000, which is 4.6 basis points, when we price this plan at our the inception of the relationship, Morgan Stanley let me aggregate the 3 plans into our pricing, break point to give you, best price. And so just like I mentioned that when I showed you with the 401A plan, looks very inexpensive because it's benefiting from 457, which is size. When we get into the benchmark reports for ICMA, the 4.6% looks very inexpensive. When we get into nationwide, at the smallest asset balance, 4.6 basis points looks very inexpensive. So, because those small plans are also getting the benefit of the larger ones. Does that make sense?
Yeah.
Freddie, of the companies that you deal with, companies that you grow your customer base with, what percentage of them have more than one employee?
Just Las Vegas. I think that Henderson is a new client of mine as well. Same configuration, Gary. They have 3, and we're in discussions right now. Some of these very same discussions. Yeah.
Are there 3 the same 3?
No, they have ICMA, nationwide for firefighters, and they have Boya. Yeah. And Boya is the 3% crediting rate. Yeah. Pardon me?
Take 5.
Yeah, we'll take 5.
We developed that.
Freddie, I had a question from a coworker, and I really didn't have an answer. They are like Fidelity.
This is
Coworker had a
supposedly
question.
pure
And
water.
he was saying, why don't companies
pulled
like
from under the ground and
Fidelity,
stuff,
I guess,
other kinds of things,
Vanguard,
ground color.
why aren't they aggressive?
Because the minerals.
Yeah.
It's dark because of the minerals.
And offering their whole power.
That is still reported, right? This is something different.
Puddle.
They just
Aside from the puddle.
So this one stands for the check marks, all right?
Because,
This one's, oh, I see all the check marks are done. So we have this one, this one, this one.
you're one of the few it started where
You know what? They
every
say
record, whether the insurance If they also have proprietary funds, they would, all the funds line up would be their proprietary. And then
I'm like, I don't understand what I'm
the
supposed to do
world
with this
started to
130.
move
I
away
see
from
'em.
something
What am I
called
supposed to
open
do with
architecture.
this?
Yeah,
That,
it's
so
ICM, CLB.
if you were doing fund options, it would be
That's the user.
highly
That's where the drop box
improbable,
is, right?
if not
Yeah.
impossible,
I tried to download
for
that.
Fidelity.
Notability?
Yeah, notability, it's like $10.
Growth fund, large value,
There should be a
large,
free
you know,
one.
core, small,
Yes.
mid-value.
I've
right?
never used it,
So,
so I was
it's
telling
not-
him,
so
like,
the
I
world
don't know,
became
I'm
moved
like,
to
Ed
an open
knows, I think
architecture
Ed,
environment,
usually when
which
people
was
have problems,
more
Ed,
advantageous for
It's too bad it gives you like
participants.
20 different
To
files.
where
that evolve
if you're
into a
Fidelity,
file.
and
Well,
if you need to make
yeah,
25 basis
those are
points,
I guess it
Well,
was-
here's the other thing,
what's,
normally
when you
their,
have
their
against
names
using,
better,
Alliance
and I was
Bernstein,
looking.
On the iPad, you
25
can't see
basis
truncate,
point
you
revenue
can't see the
share.
whole thing.
I see
And
that
so the
now.
world went open
Well, no,
architecture.
well, now that I know that,
So,
'cause I don't use the iPad.
plain administrators or record
I
keepers.
put some next to
Everyone-
Vanetta, I'm gonna
everyone-
change them.
Everyone I open up, you have to
Take a little
download
cream
it.
off the top and
And
then.
it won't, if you go try to switch to another one.
These
come back
guys
and
don't do
download
that
it again.
a lot.
Yeah.
Unless you freeze
Unless
it.
you're in notability, then I think you can, it's
I mean, they
different
take
in
the
there, and
money,
you can
they
also
invest
put
it.
notes, actually
I mean,
on the.
there's not a lot of labor, I guess,
Well,
involved
I'll
in
ask Ed, because I don't
operating.
know, actually,
I mean, there's
think
back
that
office
it was
structure
would
that they
assume
already
it's a
have
free
in
app.
place, so
Yeah.
at some point, the more assets you get, obviously their cost per
It
dollar
is.
of assets
Just
go
looking at
down.
it.
That's exactly right.
And-
Because the, you know, their costs
Right?
largely
Hard to
become
deny,
fixed.
you know.
They're not
Yeah,
fixed
exactly,
at
that's,
cost.
exactly, that's what I was getting at, the larger,
Well, you would think.
and obviously, as the more we put in, our cost per dollar in
Normally-
should go down.
Average account balance drives
I wonder if
fees.
that's.
Yeah, okay.
Yeah.
Right, there's
And flow.
$9.99.
So there's been a split in
Sure, let's
not,
see.
since Vanguard or Fidelity or
Let's do the scaled
whatever,
down version.
Janus
Well,
can't
there may
offer
be-
a whole palette
I have
or
some
the best
stuff
funds,
here where
open
I asked,
architecture took
um,
over,
I
asked
allowing
him if I should
administrators
send
to
them to
seek
you.
the best funds in different classes.
There are
Right.
free versions
Yeah,
of other.
and that's, and also consultants are a big part of that, to come in and,
No, I haven't
because, you know, a
used-
lot
I
of
haven't used
plans,
their guide.
or not anymore, but at some point, you know, plans didn't have a third-party consultant. And for the record
It's only
keeper, it's like the, saying, the fox watching the hen house.
Did you find it under?
There needs to be a
I just-
watchdog.
Oh, he
I was just logging in to Dropbox.
Keep everybody, you know, fair.
Well, I know a lot of friends of mine work for small companies, and you know, I'm like,
Yeah,
well, where do
'cause
your,
then you have to-
where do your
then you have to
palette
take
funds come
notes.
from? I don't know,
On a.
the CFO or something is taken out for lunch by some consultant, and we end up with a form change plan every 6 months.
It happens. It happens.
I know, I was kinda like, wow, because he's just stuck in some Hartford funds that are just
Well, you know, when you're down market, your costs are so
Well, yeah,
high.
that's the thing.
And,
I wonder if it was already on.
and there might be literally,
I never had.
you could log on, there
Well,
could literally be
that's what
60
I'm
funds to choose
wondering,
from, because there isn't
I'll
a
ask Ed
consultant.
also.
Yeah, in the App Store.
There's just a
Oh, yeah,
record
he's-
keeper.
yeah,
And
and
there's
some,
nobody-
some of my friends have small plans that do open it to the entire palette of Fidelity and
And they
Vanguard.
wake me up.
So you're talking hundreds,
For a
and
minute.
then another hundreds of ETFs. It's
It's like
really
calling
quite
my
mind.
name.
It's too much.
Yeah, and they get
I've been so
analysis,
good at
paralysis,
not eating sugar.
and
Yeah.
then paralysis by analysis, and they don't know what to do. And then they fall back and just go, I'm just gonna total stock market.
Yeah.
Or it's follow the Warren Buffett rule, put it in the S&P 500.
Oh.
All right,
Is it
getting
maybe
through
one?
things.
I don't
Thanks.
think so.
Sure.
Don't eat it.
Bonus.
It's like,
Like a mistake.
it's like
That's
the
a bonus.
wrong- Yeah.
Yeah, baby.
bonus.
Or maybe it's like one of those quarters that has the wrong mint stamp on it, you should save it for.
Well, I was thinking of like the,
Okay.
but I wait and see if it's Super Bowl.
Once it gets out,
Good day.
for them to review and they get it, okay?
See, take it home, you might win something.
It goes just like that.
I'm not sure what that thing is.
It doesn't even look like a dog
It
breaker,
comes
huh?
up after that, has something else in it.
Damn, wow.
Because what they approve is what they seen, what we sent them. So that's why, so when I saw,
Oh, they've already approved?
they reviewed it,
Right.
approving, meaning they're saying, we're good to go.
You bet thanks for
Yeah.
500.
But they haven't done that
Put that in the plan.
Yeah, but just eat
I
it.
pulled it up.
yet. Okay, so maybe I'm,
50.
so you close your file, that goes directly
It
to
has
the,
to go. I don't leave the day it closes. I wait till
right.
I sit there and I have to pound before I leave it goes to them.
Santa Clara.
Santa Clara.
Staff.
So they say,
Once they approve it,
are you involved in?
so that we know. So when you guys said change, I was thinking, oh my God, this might be too late. So I was already rolling it out, but I had to talk to
Yeah.
But
Well,
Stacy
we
was
do
like,
want to change and all
it's
that
one thing
stuff,
I
so
did
they're
not
always
see.
bringing stuff.
Any changes were reminded, take it off.
Cause they call us all the time.
So I know if I have one little,
I'm allergic to sugar. Makes me pop.
Me too. So I can eat it.
I swell up when I eat it.
Banana's one that
I'll probably gain
it
5 pounds.
was initiated.
So
I told them now we can give us
Yeah,
breakfast.
really have to, oh, I have to.
Well, you know,
And Vince, and yes.
Oh, go ahead. He was saying what?
hey, hey, you,
Change on.
you look at, mine? I don't know, it was one of the contracts.
The one that said that.
Stay away from my donuts.
Oh, was that on this one? Was that on this?
Right, more of that.
Oh, okay.
I read another one, I read another one, before I left work, I read for every
Yeah.
call.
We did not.
I was like, okay, I have a problem.
Yeah.
I did it, I'm done.
Donuts always.
No, I know that, that's right, because I got burned last
I know,
time.
right?
Yeah, I know exactly.
One day, John, I'll vote for you.
I only have half of the time.
Have a sense of power.
Sugar's delicious.
Oh, I know.
I think it was the appeal, right?
Oh, yeah, why did you get that?
Change something.
I don't have.
No, so I second now instead.
Second still.
It's your best.
Yeah, that's what I was thinking.
I talked to Danny. That's the
Why
Plus,
can't we
plus
get
the
like-
red ones that I had, I sent them to Terry and it was about,
Yeah.
and I don't know if he, and I had
So
to
I
do
said,
it yesterday, so I don't know if they,
So-
so if they
Like
gave me
this,
that comment,
since
I have to
it's-
borrow it back. Yeah, because those were weird.
I was going to say,
And that's the question.
I got rid of feedback flag.
It's
So,
Like 6 foot, and he probably
just,
was
if anything, I would just distribute the minutes that we get.
And
If
then my
there's any specific questions on the financials, we'll just go on that. I'm like, yes, ma'am. Why?
But I was wanting to see what the change was, because I knew that Stacy was
basically
gonna
what
have.
this is the word the ratification.
Which, by the way, am I supposed to, so I'm supposed to, this is where I get, I'm getting into that, so I'm supposed to rush
whole day
I'm
is
supposed to rush
essentially
here and tell them about my two other items.
spent on it.
I meant to do an email. Yeah, I meant to do an email.
Yeah, I mean,
And you know what?
he didn't always put this whole like,
We'll get notices, cause I think you guys are whatever. You know what, then like make it, this will be announced.
Yeah.
That way I'll keep a note of it.
I know you know that.
So in that way, I'll give a heads up. That's why Stacy went.
Is he on the end?
Yes, I know.
Because you can't hear when you're, she's at the camera. Yeah. There's
The sidebars and
Yeah.
so that's why we separate. So then we said, well, Stacy, I know David said something about.
all right, good.
Yeah, so we come back, we'll marry up everything.
One of the angry guys said she had one of the.
Whatever the reason.
Somewhere up in the north by Centennial.
Oh, yeah, oh,
And
that.
he
I get it.
When they get a report about the groceries on the
Change
counter.
something. Now it's on the record, they go by, so I sent it through, they're not, what is this?
But he driven out there and
Yeah,
he
when I
went
seen-
grocery bought $400 worth of groceries.
And I'll remember when I have items.
No idea.
Put it there. Yes, right
Yeah.
You know,
Well,
I
he's
would,
not
I,
gonna know.
I heard that, I was like, why would you even take that ever again? I would never take that. Let me do that.
No, I don't know.
Everybody, you have to handcuff me down. I mean, I'm not gonna take a couple, let's try all.
I do the finance.
In a snapshot, there it is.
No, I'm never. Well, those two guys are good. Until I see them on the agenda.
Yeah.
No, now it's, I got them this time, but the previous one, because what happened was that last time I got a phone call from
Surviving spouse.
what you're talking about.
yeah, I know, but I appreciate
Give
it.
a draft to her.
Yeah, so now I know, although I didn't take it, although I got it after last but they already.
That's what I was ready to do.
That same night,
It's not going to be.
David already got it out, so he and Michael, so I think
I think David and Michelle were saying any more news.
Yeah.
The positive side from the They were not used for that.
Correct.
So for the color, I think
It's not a beach.
Yeah.
We're real happy with all of this. The pharmaceutical.
They are. Yeah. I was less than impressed with their vision.
The vision lady is not great. They had problems that have gotten more serious. I think that was going to be a big situation. There were some concerns about that.
You can really tell me when
Statement, that's why this email says, hey, we're paying on that. Now, which is surprised because customers, that's right, that my stuff.
Yeah.
And then BHO is okay.
BHO's, yeah. That they send every.
You and I both know. Goddamn one. Put it out, yeah. I'm telling you. That's why, and I don't know if,
Somebody's taking care of it.
Well,
it took me like the first minute, I was on the boxes, Mark he mentioned it was passing, and then the next one, Mark had called me.
Yeah, I know.
I know. Get there.
Exactly.
You guys are always looking.
Oh, thank you, Vanetta.
You work in the second half here?
I'm going to do just that.
All right.
How are you doing?
Good, thank you. How are you?
I'm doing good, thank you.
so I wanted to.
I can-
We need to
you can
put
write that up.
foot down.
Yeah.
Pardon me?
These are all live?
Yes.
Yeah.
Hey there, how are you
I'm
doing?
well, how are you?
I am good. Hey, John.
How are you?
I'm good, thanks.
Shall we reconvene here? Okay, we'll look at the ICMA review. Starting at page 19.
Down low. All We're not doing this. Yeah, we're not doing this one. Not yet.
Okay, we can start on page 19.
Yes.
Okay, just checking.
Yep. And so there's our, again, no thank you, have some thanks. There's our watch list. You've got the Vantage Point Retirement Income Fund, that's the part of the Target Date Fund series. You got the 2010, you got the 2015.
If you get rid of one Vantage Point fund, don't you have to get rid of all the target date funds?
Yes, that's a good point. They do come as a series. So you have to evaluate them as a whole, but the committee's still staying for the program and putting individual ones on the watch list for the rankings, merit that.
And do we really still have the 2010 target date fund active?
Yes, because the way Vantage Point, they're managed through retirement, so people that are still in those, they still, some series, bleed into retirement income funds, but not so in the Vantage Point funds. Look at page 20, and there's our fund lineup. You'll notice that they're picking up a very, very small balance in Fidelity Government Money Market Fund before the money market reform that went into effect last October. It was a Dreyfus Prime Money Market Fund, and that isn't really an investment option open to participants. It's a small balance that has some forfeitures in the 401A. And then you've got the Target Date series. Now, the 2055 fund was added, but there's no balance in it yet, so it's not picking up. But it is offered in the fund lineup. And there's your Western Asset 4 Plus, inflation focused. Page 21. Now, in this particular case, there are two actively managed large value funds, just because the performance has been so good on both of them. The committee's had a hard time justifying getting rid of one. There's your large blend, one actively managed fund, one index fund. Large growth, same thing, two good performing funds. Small, mid-value, mid-growth, but yet if somebody wants a mid-core, there's the small mid-index, as you can see, that can fill part of that. And then there's the large value, or small value, small growth,